All right, hello everybody. Thanks for joining us today for a crash course on C Corp Taxes with GBS. To get the initial questions out of the way, we will be recording this. We will provide a recap. So if you miss something or have additional questions or want to read text or look at all of this later, you will be able to. We'll also distribute a video of the presentation, so you will have all the info you need. Thanks for being on time. Sorry we're starting a little bit late. We had some technical difficulties that we've now gotten through. Super happy today to have Crystal Stranger here from GBS. GBS has been an awesome tax partner for Gust for many years now, even helping us with some of our own tax questions and navigating all the complexities. So with that, I will hand it over to her. Thanks for being here, Crystal. Can't wait to see what you have to say.
Thank you so much. I'm excited to be here. I've been in the tax world for about 20 years at this point now. If you have any questions or comments, I assume there's a way that the attendees can send that over, correct? We'll
Yep,
try to address as
absolutely.
many as possible, but yeah, I do have to keep it around an hour. Yeah, I'm excited to be here. If you have any other questions, you can always email us, taxprep@gbstax also. So first off, I mean, this is about corporations, so it's always good to start with a little bit of the benefits of corporations. Generally, the benefits in the past were more about legal stature and being like a strong liability protection shield. But actually, more recently, there's more tax advantages now with C corporations than there used to be. It's actually one of my personal favorite structures at the moment. I think they're really great, and they have a lot more place in asset management and as well as tax advantages for building a company these days. Some basics is there's a lot of formalities you really need to keep up when you have a corporation. You need a formal structure with, titles like president, CEO. You need somebody in one of those kind of authority roles to be able to sign tax returns. Hence, that's pretty important for tax purposes. You need to be, keeping up. Corporations should be entered into for the purpose of, making a profit. So if you have loss year after year, you're going to be a target for getting audited. There are some exceptions to that, with charitable corporations, B Corps, but in general, that's the case that you want after a certain amount of time to be profitable. It's also good to touch a little bit on some U.S. taxation basics of understanding kind of how tax is calculated, because not everybody who attends these webinars are really familiar with that. I run into. So, in the US, tax is on the net amount of income. There's no gross receipts tax. It's on the total amount of the income. So this is really important to be able to, calculate that income correctly. Currently, corporate tax is a flat rate. It's 21%. So it's relatively easy to calculate once you have the, that amount of the net income figured out. There are some elements of what can play into that with deductions and how you calculate that. The other important element here is that tax is owed when it is earned. So with corporations, this means even in the first year of doing business, you may need to pay estimated taxes before you've even filed your first tax return, or you may have a little bit of interest that's calculated on that tax that was owed over that period. Additionally, you can choose for corporations to have the end of the tax year at any time. Well, not any time throughout the calendar year, I should correct myself, at the end of any month in the calendar year. So you can pull a page out of the Salesforce book and have January 31st be your tax year end, or you could have, say you have another company in Australia, you may want June 30th so that the two companies' books line up. Basically, any month that you have, a reason to want to end in that month can be the end of the month for operating purposes, or for the end of the year for tax purposes, I should say. So 1120 is the basic tax return that all corporations have to pay. And after the Tax Cuts and Jobs Act, it became a flat 21% tax that gets calculated on this. However, there are some, other, credits, deductions that you can apply still. One of them is the FDII, Foreign Derived Intangible Income Discount, and that can reduce the effective tax rate to 13.125%. So that can be a pretty valuable discount to be able to take. Generally, corporate tax returns are due on the 15th of April if you're a calendar year taxpayer. If you're not a calendar year taxpayer, then it's 3.5 months after the end of the year, with one exception, which is the June 30th end date I mentioned. Instead of October 15th, it's actually due September 15th. And then an extension is available for an additional 6 months. So for calendar year taxpayers, that's actually October 15th. This year, the dates are a little wonky. Actually, they don't fall on the 15th, I think, more years than they do, especially the April deadline, because of some DC holidays and federal government holidays that are there. But this year, it'll fall on the 18th of April, which is Easter Monday, which is not a holiday according to the US, I guess. And then if you are not ready to file by then, you can file an extension to October 17th. We've changed our policy to file extensions for all returning clients automatically, but we also have a $50 extension filing product for new clients if you're not ready to sign up for taxes yet. So for Form 5472 is attached to the corporation's tax return. This is only if you have foreign shareholders or transactions with a related foreign company. So what's a related foreign party? Well, that's either a shareholder, like 25% or more owner, or a company that's owned by a non-US person or corporation with that connection. So this can be attribution connections. Say, I had a call the other day with a client who he's doing business with his father's company, and because the father's company is a corporation, even if it was directly with the father, because of the family relationship, there is a 5472 requirement. So, some examples of reportable transactions are, purchasing inventory, paying rents, royalties, commissions, loans to shareholders are a big one, or loans from shareholders. So most financial transactions between a foreign shareholder and a US company are going to be reportable on this. Thing about this form that makes it really dangerous, and why I spend a little bit of time talking about it like this, is that there's a $25,000 penalty that's assessed if this form is not filed on time or is not filed correctly. And the IRS hands these out like candy, and they are now nearly impossible to get waived under reasonable cause or first-time abatement. They're very difficult to contend with once the penalty is assessed. So the best thing is just to not get the penalty and to be really careful, do file on time, file an extension if you're not ready to file on time.
Can I ask a quick question there, Crystal?
Oh, can we wait till the end to do questions?
Oh, sure, yeah, definitely.
Yeah, okay, great. Yeah, otherwise I don't know if we'll get through everything. We can get waylaid with questions that way.
Yeah.
Another federal tax element to look at is SCorp Elections. This is an election you can make to have the income from a C Corp pass through to the individual level. This is only for US shareholders. This is not available for foreign shareholders. But this is a way of getting around that double taxation, where the income is taxed once at the corporate level and once at the individual level. The thing to note about this is this used to be really valuable pre-Tax Cuts and Jobs Act, but right now there's only kind of a small range of clients where I see a benefit from SCorp Elections. So we only do a couple of these a year now. I used to do quite a number of these every year. Another important element of note related to corporate tax is the 83B election. This is when you first issue the shares in your stock, and it's probably something that all the kind folks at Gust have told you a little bit about. But if you have a vesting arrangement when you are issuing the stock, you need to file this 83B election within 30 days to prevent the vesting being treated as income. So that's the way it works, is if you don't have this election filed, then as your vesting is attributed to you over the 2-year, 3 or 4 year period, whatever it is, you would be eligible to have to pay tax as if you're earning that amount of additional money. That is the valuation of the stock. And the reason this is so common in the startup world particularly is that most companies, when they're started, have very little, if in most cases almost no value. So you can file an 83B election without there really being any risk. If it's a larger company and you receive like a vesting arrangement or a share option grant, that kind of thing, then you would have to pay tax on the year when you make this election. But for startups, this is really valuable and doesn't cost a lot to get done for the protection it provides, but it has to be done within 30 days. I want to briefly touch on foreign subsidiaries. I don't think a lot of Gust clients have this, but if the US company owns a foreign company and has 10% or more interest in it, you may need to file Form 5471 each year. This is another one of the high penalty related forms, which is why it's worth mentioning. But it's also incredibly complex. These are typically 160-page tax returns at a minimum for a relatively simple 5471. Thus, if you do have a foreign subsidiary or if you buy into a foreign corporation, be sure to give yourself extra time for filing taxes, because these are probably the most complex tax form under US law. And they're, I do a lot of them, but they're definitely complicated and take a lot of extra time and care. So this is 1120F. This is another one in the foreign range. This is for a foreign corporation that does business in the US. The reason it's important to mention is that if you don't have a subsidiary and you do have a foreign company and it is doing business in the US, you may have to file this, or you may need to file it at some point to claim treaty provisions. And if it's not filed on time, there's no penalties, but after a certain amount of time, you lose the ability to claim expenses. Thus, all gross income is taxable, and a lot of protective 1120Fs are filed in order to prevent this. All right, so we've covered the bulk of corporate tax in a really brief overview of it. Now we're going to look a little at state taxes. So 44 states levy a corporate income tax currently. This goes up and down a little bit. Some of the states that people think of as tax-free states in the US actually have a corporate tax. Florida's a good example of that. A lot of people will set up companies in Florida thinking that, if you're using a Florida address or you move to Florida, then you're getting away from income tax, but corporations are actually taxable there. Texas has a franchise tax that has its own separate requirements. It's not a corporate income tax, but it still is another corporate tax of sorts, although it's usually minimal for startups. It can kick in later. So this is something to take into consideration, that just because a state is tax-free for individuals does not mean it's tax-free for corporations. Whether or not you have to pay taxes in a state that you're not physically operating from is another really complex mess of nexus rules right now. This is expanding and changing these days. A lot of states have been passing new rules to establish minimum connections for income tax purposes with fairly minimal connections for certain types of businesses. But some general factors are having a physical presence in a state, such as employees, often independent contractors can also trigger nexus. Having economic activity of sales above a certain threshold also often triggers nexus in certain states. California, for example, determines nexus with this beautiful criteria. This is 2019 numbers, but you know, essentially, if you're engaged in business in California for any kind of financial gain, organized or domiciled there, and domicile in California often also includes like board members being located there. So you have to watch out for that. California likes to draw this very broad, although you sometimes can argue it back. The problem is for, you know, small amounts like the $800 minimum tax, it's not really worth arguing with California. For larger amounts, sometimes it's reasonable to, but it's just not very easy because their criteria is extremely broad. Delaware franchise tax, I believe most everyone on here is a Delaware corporation. Of course, the Delaware deadline just passed last week. And now it's still possible to file, but there's a $200 penalty for late filing. The biggest, most important thing about Delaware, I'd say, is to issue shares. I usually recommend issuing at least 70–80% of the shares in the first year if you're a new company. If there's no shares issued or a really small number of shares, which can happen, back to our vesting example again, in those cases, sometimes you can end up with quite a high Delaware franchise tax amount. Sales taxes, we don't do sales taxes at GBS, but I do some consultations on this matter, and I want to mention it just because it's one of the types of taxes that can really surprise startups, especially in the tax world, in the tech world, because you know, SaaS income tends to be taxable in about half the states, regardless of if you have any presence in that state. There's a lot of gray areas when it comes to software, also when it comes to marketplaces, if you have any kind of a digital marketplace. This all flows back to a Supreme Court case a few years ago, South Dakota versus Wayfair, you know, the online furniture store. And that court case was very broadly written to encompass both goods and services in different states, and allowing states to pass rules about that. So it's kind of opened a Pandora's box that has changed and is still constantly changing the rules about when you need to start collecting sales tax very quickly. Payroll taxes is another type of tax that a lot of our clients tend to contend with. It's important first to understand if you have employees or contractors. So employees, you know, usually the main element is control. So it's who has control over, you know, when, where, and how to do a particular job. So if the employee has control over that, well, maybe they may fall more on the line of independent contractor. If the company controls and provides, you know, computers, equipment, everything like that, it's more likely they would be seen as an employee. Of course, with remote work, a lot of these, you know, broad strokes have gotten closer and closer together for employees and contractors. Some states have stepped in and put legislation in to further refine these definitions. So it's important to look at this closely and make these determinations, make sure you're both not violating any laws and that you have your workers classified correctly. For US employees, one of the reasons people prefer independent contractors is it's a little simpler paperwork wise. If you register and you're paying employees directly, you need to register in the state, withhold taxes, FICA from the federal government, pay to the IRS, do state withholdings. There's a lot of elements. It's gotten a little easier. There's a lot of PEO services popping up, both in the US and internationally for hiring employees. And with the PEO service, the employee becomes the company hires them as like an employer of record and then just issues you an invoice to pay the company who pays the employee. So that can be beneficial. But if you are paying it directly and you're at that point and you're paying a large amount of wages directly in the US, please note that trust fund recovery penalties are by far the most harsh of any IRS penalties. Those are the penalties if you don't pay in the Social Security, Medicare type withholdings of your employees. Thus, payroll taxes should always be prioritized and timely paid. I can't ever stress that enough because when companies are struggling financially, I've seen it before that they try to push off paying these withholding allowances, and that division of the IRS is so extremely harsh. You never, ever want to deal with them. So independent contractors are the other end of the spectrum, and when they're US independent contractors, you'll collect a W-9 from the payee, and then if you pay them over $600 in the year, you have to issue Form 1099 NEC, and that should be filed by January 31st. For foreign independent contractors, as long as they're not US citizens, the general concepts is that income is sourced to them only in the country where they are a resident of. So there's no US withholding on the company's side for paying non-US independent contractors, but you should definitely document that they're really not US persons. So you want to get a Form W-8 then to get their information. It's not filed with anyone, it's just for the company's records. It's also a good idea to have a contract where they're saying they're not a US person and a copy of ID, something like that. It's good to always get a copy of ID for anyone you're paying so you can prove they are who they say they are, right? So it's another one of the foreign reporting farms is the FBAR reports. So if you have a foreign bank account under the name of the company and you have even for a day during the year where the balances exceed $10,000 US, you're required to report this. Often if this is required, then Form 8938 that's filed with the tax return is also required. These forms also both carry a $10,000 minimum penalty. So it's important if you have foreign bank accounts to file these forms because the penalties for not taking care of foreign informational reporting is just so high. Tax planning, I love tax planning. It's hard to sometimes get taxpayers to want to plan in advance, but you can do so much more if you look a year ahead and if you're documenting while you are doing the activities that would be an expense. So it's really important. Depreciation is important these days. Meals are more valuable these days. They're deductible 100%. You've also, for some companies, like generally I always recommend cash basis in early years. So it reflects the bank account. I think it's just much easier for entrepreneurs to wrap their head around and have that be for tax purposes as well. It's much more understandable and costs you a lot less to prepare your books correctly in both time and money. However, when you get a little further along, there can be advantages from accrual accounting, especially in companies that, for example, are running like Kickstarter campaigns and stuff like that. There can be a lot of advantages from accrual. Again, keeping these records and keeping this throughout the year is really valuable. To have, these capital contributions tracked, your chart of accounts, your startup costs or amounts that are paid prior to forming the company. So those can be deductible. I like to mention that because not everyone knows that amounts you pay prior to formation can also be deductible in the first year. And that meals and entertainment, like I said, is 100% for last year and this year. Also talking about credits, I'm reluctant to mention R&D credits a little bit because there's been a lot of shady companies in the R&D space that have taken advantage of a lot of companies, in my opinion, and I think this is going to backfire, and it's going to be one of the largest audit areas in the future. It can still be valuable with the proper due diligence and documentation, but you just have to be really careful that you qualify and you're meeting all the requirements of the credits to be taking this. It's, the beauty of it is it can be applied to payroll taxes up to $250,000 worth. The problem is that with it being practically a refundable credit, there were a lot of companies that were offering these and taking a large percentage for filing the credit, which is really unethical in, in my opinion, or in the, a lot of professional opinions, because if you're taking a percentage of the credit, it's in your best interest to inflate the credit as much as possible. So it had gotten really bad. That's why we started doing this, to try to do the due diligence properly and help clients with this. There also is the employee retention tax credit. So if you started in the post-COVID world and you had employees in the third and fourth quarter of 2021, you may be eligible for up to 70% of the wages paid as a credit, which is also pretty amazing. These are some important dates for 2021. I kind of touched on these a little bit. April 18th is a really important one. That's the C Corp due date. And then if you file an extension, it's the 17th of October. How can we help you? I do a ton of consultations to really work with companies one-on-one and structure, different types of, basic, tax planning and setup and understanding better any situation specific to the company. We do bookkeeping setup. We do monthly bookkeeping. We have a lot of great packages for this. We do end of year tax planning. We do, 1099 filing, Delaware franchise tax, U.S. income tax, state income tax. We also do some individual income tax returns only for clients who do business taxes with us. And then, like I said before, we are doing those credits now as well. So yeah, that's the basic material that I kind of, sped through to give you guys a little crash course, basic information about corporate taxes. And I'm happy to answer some questions here. I'm sure Ryan, Nash, you guys have got, or sorry, I'm a little overwhelmed from doing all that, but I'm happy to answer some questions too. So
cool. We have a few in the chat for sure. Ryan, do you want to start with yours, or did you get it answered throughout the presentation?
No, I did not. And I'm trying to remember the form, but there was a form 7 something that you have to file if you have international shareholders or doing international business.
Yeah, 5472.
5472. So my one question, this is probably a lot of our founders or people who are doing startups. If you have
Mhm.
people who have convertible notes or safes and they're foreign individuals and they're a substantial, right? $100,000 safe in a company. They're not a
Mhm.
shareholder yet, but do you still have to
Yeah.
file that form?
No, you wouldn't because they're not yet a shareholder, so they don't actually have any equity at that point.
Gotcha. Thank you.
Mhm.
Cool.
No worries.
I guess that's an interesting one too. One thing that we recently noticed is that the newest version of the YC Safe has some
Mhm.
recitations in it where all of the parties are agreeing that the transaction will be treated like a stock transaction for the purposes of
I've
certain
noticed that.
tax areas.
Yeah.
Do you know if that makes a difference?
So I don't think it does because I was looking at one of those recently and contractually, you can't really agree to how
Yeah.
something is going to get treated tax-wise. I think it's a little crazy, honestly, to be seeing that. I guess maybe it's, if there's any question about it, it would fall to that. But, I mean, tax laws generally set both by statute and by judicial intent. And, you can't say, oh, well, this is not foreign income because we signed this form
Yeah.
that said it's not foreign income, right? So, or vice versa. So,
Well, I guess like many things around the safe, the answer will often be, I guess we'll have to see how it plays out the first time somebody gets in trouble for it. All right,
it
getting to
won't
the
even be the
questions we've got.
first time someone gets in trouble with it because, there will have to be a really high dollar
Yep.
case for it to make it to tax court because the small cases, the way the tax court system works is any case, I think it's under $50,000 of tax controversy, is like considered a small tax court case, and it doesn't create precedent when that case is decided. It has to be a bigger case in order for it to be used as precedent later. So, you know, and then a lot of times if it's a bigger case but not like important enough, the IRS will work really hard to settle those cases so it doesn't become precedent with the idea that they may have another case with slightly different facts that are more in their favor. So they'll really cherry pick the cases that they take. Like the litigation department of the IRS is really sharp and really well run. It's not like the rest of the IRS. It's a disaster right now. Like the litigation department is really together. And because of that, the IRS keeps winning really landmark cases. Like I mentioned FBARs in here, they've won 2 landmark FBAR cases recently that now they're really feeling empowered from that and going after all these international information return penalties with so much more fervor that it's frightening. So,
That's fascinating. Thank
yeah.
you. I mean, I love when we get people on who are as like wonky about their area of expertise as we tend to be about corporate formation. I think it certainly makes us feel like we're in good hands when we work with you, and I hope that
Yeah.
extends to everybody else.
Oh,
All
I
right.
read everything I can get my hands on that comes out of the tax court and is
It's also
IRS precedent and changing because I mean that's what's really fun about tax is it's constantly changing and it can be hard to follow those changes because they aren't very well publicized necessarily. And I mean, Congress decides something or they come to an agreement and then it may change. And when it actually is like signed into law, it's completely different than the earlier drafts that, I read and did commentary on. And you have to read everything so carefully. And then, how it plays out later with, how then the IRS will structure the forms around it and where things flow in on the forms can be really interesting. And then the guidance that's issued from the IRS about it, and then, you know, how that plays out when it's questioned, when it goes into appeals, when it goes into tax court cases. It's amazing. So, yeah.
All right, I'm
I'm
gonna
a total
dive into
dork.
what we got from the audience now. Ricardo is asking, in cases where there are sales done outside the U.S., in particularly in Europe, what are kind of key factors to take into consideration tax-wise?
Okay, so if you're making sales outside the US and you have, you know, you're either selling intangibles or you have people outside the US that are doing the work for you, you want to look at that FDII that I mentioned, the foreign derived intangible income discount, because I don't know all the facts, but it may apply in that instance. And it would currently reduce the tax rate to 13.125%, although this may change whenever Congress stops dragging their heels and gets a tax bill out, because the ones that were going through last fall had FDII ending as part, or being greatly reduced, I should say, as part of those bills in different versions of it. So I suspect at some point that amount will change, but currently 13.125 is the effective tax rate, which is a pretty amazing tax rate to pay in the scheme of things. So, and that's why it'll probably change though, is because, you know, on a global level, there's a lot of pressure to have a 15% global corporate minimum tax. And because with FDII, it's below that 15% mark, eventually there is going to be enough political pressure from like the OECD on the US to probably change that and push that up over 15. So.
Awesome. All right, next question is, my entity is an LLC now. Should I change it to a corp for fundraising purposes, Kickstarter, or angel investor funding? That one's kind of squarely in our court, so I'll be curious to get your answer as well. Ours is typically that if equity fundraising is on your radar and you plan to solicit semi-professional or professional investors, by and large, they will require that they invest into a Delaware C Corp. If you're doing something like Kickstarter and you're doing donation-based crowdfunding or something like that, that is not a clear-cut answer. So that conversion may not necessarily be in your future. As far as when to make the transition, the more things that you actually attach to the company in terms of contracts, employees, contractors, revenue, other fundraising, the more complicated the transition can be. So it can make financial sense to do it earlier. But there are some complications from a tax perspective. You want to think about tax year end of your LLC and making that transition over. And then, you know, oftentimes things are more complex and more expensive later on, but you may also have more money later on. So you kind of have to weigh whether or not you want to do that early and get in front of it if you have the funds now, or you really want to push it down the road until you have a better understanding of your total funding picture.
Yeah, you know, I mean, it depends on the investor side. I'd say from my experience, it depends a lot on the investors. I've seen people raise at early stages with who, you know, investors that in my opinion are crazy people because they're making C Corps convert to S Corps or LLCs. I've seen it the other way around. So I'd say that, you know, your lead investor can probably help you a lot there if you're doing a round. If you're doing a, you know, smaller friends and family or Kickstarter, it probably doesn't matter that much what the, you know, what the entity structure is at that point. But if you are doing a more substantial raise, I would think that attracting talent would be more of a consideration there, and you would want to convert to a C Corp just to have that option pool to be able to attract better talent, if nothing else. The other benefit on moving from an LLC to a C Corp is that FDII that I mentioned before. It's a gray area and very arguable if that's available to LLCs that have made the election to be taxed as C Corps. Because there's an election you can make to be for tax purposes a C Corp. So I usually recommend these days to actually do the conversion at the Secretary of State level to C Corp rather than converting just for tax purposes, if that would come into play as well.
Awesome. And actually, this touches a little bit too on something that we get questioned about a lot. In terms of the SCorp election, I know you mentioned that you are suggesting it less and less for companies. One big question we see is if you take the SCorp election and you are issuing shares to founders, do you have any insight into how that overlaps with Section 1202 and QSBS?
So honestly, I wouldn't worry too much about that because I think QSBS is probably on its way out because of some of the draft bills that were in Congress last year were ending the QSBS deduction, and the way they were ending them is they were ending them except for deals that have already been determined, like deals that have already been signed by the time that tax bill would have passed. So when I see things like that being carried across a couple tax bills, to me, that usually signals that it's going to be probably passed within the next couple years. It may take a little bit of time to kind of flow through there, but it's a pretty big revenue raiser. So it'll probably get tacked in to something at some point. So honestly, I wouldn't put a lot of time or money into structuring for QSBS right now, because for a company that's starting out at the moment, low likelihood in the 15 to 20% range. I'd put it in the 15 to 20% range, that by the time the 5-year holding, the QSBS will still be in existence. And that's if you can find someone at that time to purchase the shares of the company, because most of the corporate purchases that I see these days are asset acquisitions. So most acquirers just want to acquire the assets, not the company itself, because of any potential liability with the corporate structure. So that's kind of the changing world that we're in. So you pretty much have to be doing kind of like a spell. It's really a long shot. You back or going.
Is she breaking up for you a bit, Pete?
Yep, I'm getting a little breakup. Hopefully she comes back.
On the click or something where you'd be able to sell the shares.
Uh-oh, Crystal, we're losing
open market, and that's a lot of factors in confluence for start down the road. Sorry, probably not the answer you're expecting.
No, that's great actually. It helps clarify, and we've been trying to keep tabs on it being phased out as well, and it'll be good for us to evolve our stance on it.
We might have her rewound. Can you hear us live, Crystal? You were breaking up a bit at the end of that explanation.
I don't know if it's your internet connection or mine, but yeah, try taking my AirPods out.
Okay, I think we might be back to normal speed. Can you hear us now?
Okay. Yeah.
Oh.
Again, or let me just turn off my screen sharing. I guess we don't need this anymore. So
all right, hopefully we can make it through the rest.
Yeah. I think my headset was cutting out. So sorry, I didn't hear all that. So are there more questions for this? So.
We do have some more. So Abhishek is asking, if I have a Delaware C Corp and issue 51% of stock to myself and file an 83B for it, do I need to issue more stock to reach the 70 to 80% within the year, or is 51 all right?
50, that's okay. I mean, I think 50% is kind of a minimum issuance amount to be okay with Delaware franchise tax. I mean, it depends how much money you have. If you have a huge raise and you have, $10 million sitting in the bank, then it would make a difference for sure.
Yeah, if you have a ton of assets.
Yeah,
I believe
exactly.
we've done some calculations ourselves, just with the franchise tax filing, and I think you need to get above $1 million in
Yeah.
assets before it starts to really ownership over. I'm sorry, ownership less than 70% starts to really ding you, and even then, it's in like the low hundreds or thousands. It's not like you get the $80,000 bill or anything.
Yeah, exactly. I usually start to see it around 3 to 5 million on the ones we're filing. So,
Cool. Ed asks, what kind of tax obligations would someone be responsible for as a solo founder with 0 employees, 0 sales / revenue? Startup still developing. Anything else to look out for?
yeah, I mean, if you have 0 revenue, you're not going to have any like federal income tax and income taxes that are owed. You'll have the franchise tax if you're a Delaware company. If you're doing business in another state, like say you're operating from California, even with 0 income, you'll have that minimum tax there. So you'll want to register, and it's always good in California in particular to register in the first year you start doing business, because they will waive that minimum tax for the first year if you register with them during that tax year. If you wait and you don't register and then have to file, you'll be on the hook for that $800. So.
Yeah, and one clarification we should make too is that you still need to file your taxes. You just won't owe any
Yes.
taxes, right?
Yes.
And that's
Yes. You
that's one
still
of
need to
a
file.
common
Yes, it's
misconception.
super important. Oh yes,
Um,
no, it's super important, especially because you just don't want to miss something like, the 5472s I keep going back to, because the penalty is just so high and there's really no way around it. Like once it's assessed, like the IRS is just not waiving them anymore. It's horrible. So it's really tough, really tough. So.
all right, related question from Tim. Last year they had 0 revenue, minimal operating expenses. Do you know if they can e-file their 1120? He said it's not quite clear on the IRS website. Oops, did we lose her again?
Maybe, or she's thinking really hard about the answer.
Sorry, folks, this is the most technical difficulties we've ever had with a GoToWebinar. Hopefully we get through them. Crystal, are you back with us?
Yeah, I know. I'm having half of that question. What was the issues with this? I'm sorry, I did the question part about it. It's another
Oh, sorry.
0 revenue.
Yeah, 0 revenue, minimal operating
Okay.
expenses.
Can you guys hear me?
Yes.
Can now.
Question is, can they e-file the Form 1120? He says it's not clear on the IRS website.
Yes, you can e-file 1120 with a $0 return. Yep.
Awesome. All right, question from Martin about
Sometimes
the GBS.
yeah, sorry, I should add to that last, that sometimes certain tax softwares will forbid that. So there's some little like tricks you can use to get around that. So if you're running into an issue where you can't e-file, you may be having a software issue, and maybe call the tax software provider. So, although I don't recommend filing C Corps like self-preparing 1120s. I really don't recommend that. Delaware franchise tax, fine, file it yourself. 1040, fine, file it yourself. But 1120, I do not recommend self-preparing that tax return. It's easy to get into trouble on it. It looks relatively simple, and it looks like it's just an accounting form, but there's a potential places where you can make the wrong selection and cause yourself a lot of problems. So.
Okay, I think we are still a little bit on a delay here, so hopefully, Crystal, are you still here? Did you just turn off video? All right. I think Nash, I can't hear you now either.
I'm actually here. That was just a mute button. She turned off video, but I think she might be jumping out and in.
Okay.
Maybe we can grab a question that might land in our expertise in the meantime.
Yeah, we've got some on the GBS fee structure. Martin, we'll send over details on that after this. If you are a Gust user or a Gust launch customer, you do get some discounts. Okay, Abhishek is asking, if I have issued stock on a vesting schedule on my stock grant and filed an 83B and decide to accelerate vesting to grant on a certain date within the calendar year, do I need to file anything? Typically, if you file the 83B and you change the vesting, you shouldn't need to refile an 83B because essentially from an income tax perspective, what you're doing is accelerating all the vesting.
Welcome back, Crystal. Can you hear us? Oh, it looks like you don't have a microphone. There we go.
Okay, there we go. I finally have sound again.
Welcome
Yeah,
back.
All right.
thank you. Yeah, I don't know what happened there. So,
Good. We
Okay.
got one question that we could answer in between, but we have
Okay.
a couple more, I think, for your expertise.
Great. Great. Yeah, let's try to get through this. So.
All right, hopefully the internet cooperates. All right, Meseret asks, if I have a separate non-subsidiary foreign company, what is needed? Do I have to file anything such as expenses or incomes?
So if you have a non-subsidiary foreign company, there's two things that may be of issue. One, you're probably going to need Form 5472 to report any transactions between the US company and that foreign company that's not a subsidiary. The other thing is if that non-US company is doing business in the US, which is kind of a complex many factor analysis to determine, then you may need 1120F filed for that company, which is a US tax return for a foreign company that's doing business in the US. So.
Awesome, thank you. All right.
I think Ricardo asked for clarification on the form that you need to file if you have foreign income. And I think that was
yeah, maybe a clarification on the FDII.
Oh, yeah, that's right.
Is related to that.
Oh, so it's not a separate form. It's filed with like the general business credits in the 1120. So, or it's not even general business credits. It's just filed on the general kind of deductions in a schedule. So it's not in a separate form or anything.
Okay. Alex asks, can you speak more to Form 5472, especially with regards to two companies that are related but have different tax structures, i.e. one is an LLC and another is a C Corp?
Sure. So you wouldn't have 5472 between an LLC and a C Corp because they're both US companies. But if the LLC, depending on who owns the LLC, it may add additional complexity there. Because LLCs, a lot of people are under the impression that if you're a foreign owner of an LLC, you don't have to pay tax in the US on the activities that the LLC does, which can be the case in some circumstances, but a lot of times it's applied more broadly than tax law actually allows for. So this kind of comes back to sourcing of income. And if you have a US LLC and you have sales of services from a foreign company to a foreign purchaser, then that's not going to be US source income, right? It's foreign to foreign. This is an LLC that's a disregarded entity. Disregarded entity is the default classification. If it's one person, if it's a US person, it's reported in Schedule C on your individual return. If it's a foreign person, it's considered a foreign owned disregarded entity. And there's a requirement every year of an 1120 and 5472, but it's not a It's not somewhere where you report taxes. It's just reporting really the ownership and the transactions between the company and the US and the foreign shareholder or related companies. And then if it's, you know, 2 or more people, then the default classification is a partnership. And for those foreign disregarded entities and foreign owned partnerships, that sourcing of income would apply, as I just mentioned. But you can create a lot of complexity because on the other end, if it's not clear cut like that and you do have US source income, or you have US source income maybe that is foreign income because of a treaty, then you're in a much more complex situation, and typically additional tax returns will need to be filed, like a 1040NR or 1120F. So sorry, that was a long answer.
No, I think, you know, we're contending with this more and more, especially as folks create, you know, do the flip to come to the US and have a US entity that wholly owns a foreign subsidiary. In these cases, there's a lot of things still developing, and it's really important to get some consultation to understand where kind of the landmines are and the things that you need to be aware of.
There's a lot of gray areas, and you shouldn't be getting your tax advice off Reddit, basically.
All right, I think that is all the questions that we've got from the chat. If anybody has others, please drop them in. We have a couple minutes left. I did have one question that came up as you were going through, Crystal. You mentioned a first-year company paying estimated taxes. I just wanted to clarify, that would only apply if the company was actually making revenue, correct?
Yeah, that's only if you're making profit, not even just revenue, but it's only if you're profitable. So, and you know, you see this more with companies that are moving into the US from overseas than like startups, because like, you know, startups that are raising venture funds and stuff, like they're usually losing money for years, right? But when somebody has a successful business in Africa or Europe or somewhere else and they want to start a US arm of it, then they come in and it's usually a profitable company right away. So you need to take that into consideration and start paying estimated tax payments every year. And that can be a real hassle because you need to get that EFTPS PIN. And I, you know, deal with so many people who struggle with EFTPS, and that little postcard got like thrown away somehow, or the letter with that PIN in it. It's one of those, you know, broken kind of US systems, like, yeah, let's require everybody to file online and make it really difficult for them to do it. So.
All right, we've got 2 more. Hopefully we can get them in under the wire. If you're a US-based startup with founder employees only and you wish to incentivize key contractors with a vesting share schedule, is there an established mechanism or methodology for this? Again, that one is kind of in our corner, but might get some tax perspective. But yes, there is often early on, companies will incentivize directly with common stock. Usually we see them delay setting up an equity incentive plan and issuing options out of that until the company is more established and has a handful of employees. And usually, you know, the vesting schedules will be tailored to the intended length of the relationship, with a cliff that is intended to cover some evaluation period, such that the company can recoup the shares if things don't work out. Crystal, anything to add there from a tax perspective?
Yeah, I mean, the only thing I don't really have anything to add on that, but now that I know more of the viewers may be foreign, I should add a little bit about independent contractors who are shareholders of the company and outside the US, that this is a really dangerous area tax-wise to be playing in, because it's a thin line between FDAP income, like fixed determinable annual and periodic, which is like dividends are classified in there. But for foreign shareholders, it's broader than dividends, the way that income is classified. And if you are getting payment as an independent contractor and you're having shareholders, so this is kind of relates to those vesting arrangements and everything like that, and they're being paid as an independent contractor and they're outside the US, they need to be very carefully submitting invoices every month for like the specifics of the work they're doing, not just getting paid, say, a flat $2,000 a month or $5,000 a month, because once you're a shareholder and you're receiving, and you're a foreign shareholder and you're receiving flat chunks of income like that every month, that can fall under FDAP income. And then it's a big liability both for the company and the individual, because for the company, then it's no longer a deduction because that's a dividend type payout. So it's taxable to the company at 21% if you get audited. And then it's taxable to the individual as well, because it should have had, well, I mean, again, really the company, because you should have had the 30%, up to 30% withholding. It may be less under different treaties, but the IRS will just charge 30% unless you can prove otherwise, right? And so you could end up paying more than 50% in back taxes on payments to independent contractors if it's not structured properly and documented properly. So there's a little danger with incentivizing independent contractors in that area, especially if they're outside the US.
Awesome, that's really good info.
Yeah.
All right, last one, and then we will let you go. I'm a solo founder that's only issued myself 40% of available shares. Is it difficult accounting wise to issue myself more? Mechanically, no. However, there are things that you'll want to keep in mind as the company progresses. If you're 2 years in and there have been substantial events, revenue, significant investment, you may want to talk with counsel or your accountants to see if there is a share price increase justified before you continue to issue at par. And Crystal, anything else to add on top of that?
Yeah, I mean, selling shares at a discounted price could be more of an issue than selling at, like, say, an inflated price for capital contributions. You know, also, I wouldn't say that it's really necessary to issue more shares to yourself necessarily. You could just, you know, because the amount of shares that you have at any given time, you know, divided by the total is your percentage of ownership. So if you have a large amount of unissued shares and you've already raised some investment or you have other partners in, it could be like an ethical issue kind of to issue more shares to yourself, right? Because you're essentially diluting everyone else's ownership. So I'd say that would be my biggest concern, maybe more than like the tax or accounting aspects of it.
Yeah, and if you were thinking about doing that purely from a Delaware franchise tax standpoint, just use one of the calculators. As we mentioned previously, if you're under $1 million in assets, you are probably still going to qualify for the $400 minimum.
Yeah, and if you're the only shareholder, you can always increase your shares, right?
Yeah, if it's just solo, like, and you want to top up, it's fine. The one, I don't know if Pete mentioned this, but it broke up for me this time, but if you do another issuance, you have to file an 83B for that one. It's per issuance. It's not like you filed an 83B and you're covered for any ownership in that company. Every time you do a grant, you want to be able to, you want to be sure to file another 83B.
Really, I don't think if you do a grant, you necessarily need it. If you grant it as like a whole block, it's only if there's a vesting arrangement.
Oh yeah, we just always we always push a vesting schedule for our customers, so we kind of assume that you're going to have vesting if you're going to.
You're going to assume you're going to have vesting, yeah. Yep. Yeah, but if you already own 40%, you're going to do a flat grant to up your share amount. You know, you're the only owner. I don't see a reason for.
And we see this happen sometimes where somebody's a solo founder, they've granted themselves shares for flexibility, or even like two founders, and then somebody else gets added to their team and they're like, oh, they're kind of a founding member, but they're not so much as a co-founder, or you realize that the co-founder relationship is a little different. They will do some additional grants to kind of true up where the real ownership they intended to be would go. But that's, again, early days. Like Crystal said, if you've got shareholders, if you got investors and other team members and advisors, you want to be very considerate that you're not diluting people, you know, just because you're the only board member or something.
Yeah, you also have to watch out really carefully with if you've done an accelerator program, because a lot of times, like, the percentages that they'll take is like, you know, post dilution. So if you keep issuing shares, then it'll dilute everyone else that much more too. So it may be even like a greater dilution amount than you think, or harder to get to that amount. You think cap tables can be super complex. So.
Yeah, I would say if you're getting an accelerator, be sure you understand a lot of accelerators, or especially new kids on the block, will put in some pretty wild rights for like anti-dilution protection or pro rata rights. So you want to be sure that there's not somebody, well, you just want to understand the ramifications. If there's somebody sitting on your cap table that basically has the right to always true up to a certain percentage, use that strategically for all the other grants that you do.
Yeah, I think across the board, evaluate your providers carefully. We will try to evaluate the providers that we introduce you to and make sure that they're good, but evaluate them, make sure you understand at a basic level what you're getting into when you sign on with different providers.
Read your contracts carefully, right?
Yeah. All right, last one, and we'll let you go.
Winning mentality of winning a seat in a program, have common sense go out the door, right?
Yeah. Yeah, and it's tough, right? Because if you see the help that you think you need, it can be easy to gloss over the details. It's worth your time to understand them. All right, final one, and then we'll let you go, Crystal. Liz asks, are grants treated as income?
Sometimes. Depends on the nature of the grant. That's another one of those sticky, tricky type of issues. It depends a lot on the fact pattern. Most cases, yes, they are taxable, but there are some instances when, they're for certain types of, scientific research or different things like that, where they're actually non-taxable, and then they just reduce expenses. But if you didn't have enough expenses that were paid in relation to that grant, you could still end up with a taxable amount.
Awesome. Well, I think we'll let you wrap up here. As I said earlier, we will send a recap with all the Q&A, a video, and links to where you can learn more about GBS and GBS services. Crystal, thank you so much for being here. Thanks to everyone who attended and the great questions and dealing with us through various technical difficulties. We appreciate it. Hope it was valuable, and we hope to see you at the next one.
Hope so too. It's great seeing you all again. So, all right.
Bye,
Awesome.
everyone.
Thanks, Crystal.
Thanks, Crystal.
Bye, all.
Bye.